Hi, I am Amanda Cassar from Wealth Planning Partners, and I'd like to welcome back Alex Minter, Director of the Astute Property Network. We haven't caught up for a little while, Alex. How are
No,
you?
it's been a couple of years. I think, a couple of years since we've done a video together,
It has
and
been a couple, and it's been a big couple of years.
certainly.
I think we're at the very start of a global pandemic when we last met. Now, did you do the obligatory COVID baby, the COVID pet, and the air fryer?
We did the obligatory COVID baby.
Right?
We're not doing the COVID pet yet, and I look at those air fryers and think they're way too big and they're going to make too much.
Well, 1 out of 3
noise.
ain't bad.
Yeah. Probably the most expensive one we chose, right?
Yeah,
So
yeah. Well, I got the COVID grandbaby,
you do.
post
Congratulations.
COVID grandbaby, and we fostered a cat. Does that count? So
Absolutely.
now today I wanted to pick your brains. We did touch last time we met on the Australian property cycle, and basically everything you said came true magically. Like we talked about how everything would sort of go up, which people were poo-pooing the idea, there's going to be massive unemployment and the country's crumbling and it's all going to go in a heap. And yet we've seen, the most ridiculous price rises in the property market for a long time, people massively suffering with the increases in rent. So can you give us a refresher on the property cycle and where are we now post-pandemic? If you can
Absolutely.
that'd be great.
So absolutely. What I'll do, I'll just share this screen with you here, Amanda. But just on the comment of everything came true. We certainly don't have a crystal ball. We certainly like most of the world were in uncharted territory and weren't sure what was going on, right? However, in the industries that we're in and what we do for a living is, and particularly with property, we read data, right? So, and it became very clear and apparent once you started to understand the data that it wasn't going to be doom and gloom for the property market when COVID reared its head, right? So, and that was a big education piece for us at the time, and that's when you and I caught up for our very first video to discuss that, because we were trying to get out there to people that don't be too concerned, don't be too scared, right? Around the property market, because this is why. So, but it was very, very relevant at the time, and still very relevant today. This data. So, so what we'll go through here, Amanda, is I think it's very important for people to understand, regardless of any economic event, regardless of any global event that has an impact on our economy, our Australian property market has run true to a trend for the last 200 years, right? And there's been a cycle that has been identified, not just by us, by many economists out there. And I'll reference one in a second and provide some information there for the people who are interested in learning more and reading about this. But the way the cycle is compiled and really all the way it runs really is that it's based on about an 18.6 year average time frame, right? And it's made up of, after every massive downturn, crash, recession, slow growth phase, whatever you want to call it, like the big slow growth phases, the cycle starts with a recovery phase, right? And that typically lasts between 6 to 7 years, as you can see there. After that recovery phase has done its thing, the cycle's then met with a mid-cycle dip or a mid-cycle downturn, which typically lasts between 1 to 2 years, as you can see there. And what that dip looks like, you see the market peter out a bit. It'll even come back a little bit. Won't drop too much, but it'll peter out a bit. And then after the mid-cycle dip, we enter what many refer to and what we've seen recently as an explosive phase, which typically lasts between 6 to 7 years, right? And then after the explosive phase, the land cycles, or the property market, I should say, reaches its peak, okay? Which means there's no more growth really to expect, I guess, on a national scale or in certain regions. And then after that, we see the peak in the market. The market enters a slow growth phase, right? Or a growth slowdown phase, as we've referenced it there. And that typically lasts between 2 to 3 years, right? But as a whole, from the start of recovery to the end of the growth slowdown phase, we're looking at about an 18.6 year time frame. Now, as well, I'd just like to point out, we are referring to trends here. Okay, so when we look at data, this a myriad of metrics and data that you can look at when you analyze property analytics. But we're just looking at trends here for this conversation. And by that, I mean, like, through every recovery phase, through every mid-cycle dip, through every explosive phase, and through every growth slowdown phase, property rises and falls. And just to sort of draw that there for you, property rises and falls through the recovery phase. It rises and falls through the mid-cycle dip, and it rises and falls through the explosive phase. And it also rises and falls through the growth slowdown phase. Okay,
Well,
so
it's not a straight line. No,
it'd be nice if it was, right?
How cool would that be?
Absolutely, it'd be a lot more easier to predict, right?
For sure.
And again, human psyche, Amanda, is we all want to avoid buying at the top of the market and then seeing a downturn, and we all aim to buy at the bottom of the market so we can see growth pretty quickly. But again, it's about understanding what phase that we're at in the cycle. Which will help us understand, or help a buyer understand, okay, well, what to possibly expect going forward as well. So,
Cool.
but for the people,
Can I just go back to that one quickly,
Sure, yeah.
Alex? One question I've got on that. So I'm Queensland based, you're Sydney based.
Yeah.
How do things like, we've got the Olympics coming up, and, there's a lot of talk now that, hold on to your property for the next 10 years because that's going to make a massive difference. So
yeah,
are things just going to keep going according to a cycle, or does a one-off event like that have an impact on property markets?
really, really good question. And there's another, and we've got plenty of content and webinars that we've actually put together on this, right? That's another hour conversation
Okay,
itself.
well,
but
we can leave that for another time, so give us the quick answer.
No, it's a really, really good question. But to condense this, right, or to condense the answer, history shows us, and this data supports this every day of the week. History shows us that certain areas and certain cities will always perform better through the recovery phase of a cycle. Okay, and then history also shows us, and look, if I'm going to be a bit specific here, right, Sydney and Melbourne have always taken the lion's share of capital growth through a recovery phase.
Yep.
Okay, they've always done the best.
Yep.
And you can look at 200 years worth of data to see that. Right now, history shows us through the explosive phase, or this time in the market, the second tier cities have normally shone a bit higher than what Sydney and Melbourne have done.
So this is when Perth took off and Brisbane took off, those kind of recoveries.
Exactly. And if we look at where we are in the cycle today, from a percentage point of view, Amanda, you look at the likes of Brisbane, you look at the likes of Perth and Adelaide in the second tier markets, from a percentage point of view, they've outperformed Sydney and Melbourne. Okay, so they're always due to do that. Yep. Right now, in regards to the question around the Olympics, like my commentary on Olympics is that's not going to put upward pressure on a market. I mean, the market doesn't rise because the Olympics are on, but what the Olympics brings is it brings astronomical spend from the government and upgrades in infrastructure, which draws people to the region. And it's not just seeing. Exactly right. We're seeing that, right? So look, the Olympics will have a positive impact on Southeast Queensland. But again, like in regards to where people should be looking at the moment today, it's not about that. But my commentary is don't just buy because the Olympics. Just make sure that there's all the other fundamentals there that support upward pressure on property pricing. So.
Perfect. Well, let's come back to that another day.
We will. We will. And just sort of referencing the cycle again here, or information on it for the people out there who are interested in this sort of data and commentary. And reading. There's a book out there written by an Australian economist by the name of Phil Anderson. The Secret Life of Real Estate and Banking is what it's called. Now, he, when pre-GFC, he was advising a lot of people on shares, and I think he took a lot of his clientele out of shares, or he suggested people should be withdrawing from shares. And I think he saved a lot of people a lot of money at the time pre-GFC because the GFC happened, right? And in an interview in 2017, he was also he mentioned there'd be a near recession, or a recession will occur around 2020. And I don't think anybody, including Phil, knew it was going to be in the form of a pandemic, right? Nobody knew that was coming. However, based on the cycle and based on what was due at the time, a recession or near recession was due. And we actually did go on to record that recession from June 2020 to December 2020, right? So that happened. And he also spoke about the mid-cycle dip or the mid-cycle correction happening around 2020 to 2021. Now, we saw that mid-cycle dip and that mid-cycle correction in between 2018 and 2021. If you had clients who owned property in Sydney and Melbourne at the time, Amanda, they were the markets that came right back, right? The likes of Brisbane or Southeast Queensland, where you're based, that remained very, very buoyant through that mid-cycle dip, but we saw property come right back. And then now we've certainly left that mid-cycle dip into the explosive phase. So look, what we're looking at here, I really like this graph that CoreLogic released. Now, this was the one that they released in 2020. I think, Amanda, by memory, I think we actually used this graph last time that we caught up a couple of years ago. It would have been around March 2020 last time. So what this graph allows us to do is it allows us to take a step back and have a zoomed out look on how the property market has performed through global events that have had some kind of impact on our economies, right? But again, that's another hour of conversation to really zoom in on certain things there, right? But what I would like to show you here or share with you is if we think back to that previous slide around the shape of that trend, okay, I want to show you how the last cycle went, right? So if we go back to the last cycle, from 1990 to that 1995 mark, thereabouts, that was the recovery phase of the last cycle. And then the mid-cycle dip.
After that recession we had to have, wasn't it?
It was, yeah. The 90s was that recession, right? So then we'll met with the mid-cycle dip. So property recovery, you can see there, property recovered out of that recession, right? Which, again, the Australian property market is very resilient, which history always shows us that we typically do recover quite well from large economic events.
Get back to that great Australian dream.
It is.
Owning your own home.
Mid-cycle dip happened, right? Then you can see there the trend. Oh, my little thing's not working. Don't know why this is not going on. Sorry, it's just crashed on me. Where are we? There we go. Sorry, go back here. The explosive phase happened, where the land cycles peaked around that sort of 2004 mark. And then the really slow growth phase happened, which sort of came to light around the pre-GFC time, right? So look at that shape there. You can see that shape. And then that's the shape of the trend. Okay, so now we're going, okay, well, whereabouts are we at in today's cycle? So I don't know what's going on with my computer here. Sorry, Amanda, it's not oh, there we go. So from GFC until 2018 was our recovery phase, and again, that's where Sydney and Melbourne, if you held property in Sydney and Melbourne at the time. So think about this, Amanda. Remember GFC times, a lot of people were afraid, and a lot of people had to sell their properties, right? And they thought, well, the market's tanking, the market's crashing. If you held that property from GFC to 2018 or thereabouts, how much growth do you think you saw in Sydney and Melbourne?
That extra 10 years.
Yeah, you doubled your money or thereabouts, right? So Sydney and Melbourne took the lion's share through that time. So that was our recovery phase of this cycle. We've gone through the mid-cycle dip between 2018 to 2019 or thereabouts, and then we know from 2020 to 2021 onwards, we know the property market has shot the lights out. Right now, again, this graph here really only goes to 2020 because CoreLogic, I believe, release these maybe every 5 years, so that's why they're broken up into 5-year increments. So that's finished in 2020. Now we're very confident that the property market has obviously increased significantly past 2020. We do know that we have seen a bit of a dip at the moment because at the moment, obviously, we're 2023 or thereabouts. So for a lot of economists now, Amanda, it's about working out when this peak is going to come, and then we can expect that growth slowdown phase. So that's just to give you an example of there is a land cycle out there. There's plenty of data on it. We provide a bit of commentary on it. We have quite a few webinars and stuff that we've done on it, but But yeah, again, for a lot of people out there, regardless of the economic events, regardless of the rates, regardless of the environment that we're in, the cycle has shown us that it's more than likely going to continue to remain true, and help us sort of see what to expect for the future as well.
Brilliant. Thanks so much for sharing, Alex. It's been a great reminder. Appreciate
No
it.
worries at all.